Today's stock pick is SweetGreen, ticker symbol SG, which is a fast casual restaurant that IPO'd to tons of fanfare a few years ago, but has since seen a really steep drawdown, currently sitting at a market cap of $1.5 billion. So instead of reading to you a paragraph about what SweetGreen is, I think it's just easier to show you. So I'm going to play this background video that's on the company website as I describe what SweetGreen does. Basically, they're a fast casual restaurant, much the same as like a Chipotle, where you go in, you get custom order. Like Chipotle does burritos and burrito bowls, SweetGreen does salads. So you walk in, you say, hey, I want this on my salad, or I want this type of salad, and they build it for you custom. The company also tries to separate itself by sourcing its ingredients in a very sustainable and local way. But at the end of the day, the important thing to know is that this is a restaurant, they serve salads, and that's pretty much it. Now, what made SweetGreen interesting to me is the fact that the company's shares dropped 23% after its most recent earnings, which was only a couple days ago, and that's because the salad chain cut its outlook for the second time in 2 quarters. Basically, they came out 2 quarters ago and said, hey, we're not going to make as much as we thought we would, and they lowered their guidance, and then they came out again in this earnings and again said, hey, we overestimated how much we were going to earn, and lowered their guidance once again. The company cited issues with its loyalty program, which is never great, weak consumer sentiment, which I haven't actually ever eaten at SweetGreen, but I think their salads run in like the range of like $15 to $18 a salad, which is a lot, especially for hard-pressed consumers. And then they saw, of course, tariff headwinds due to importing certain ingredients and store challenges, which is quite general and doesn't really explain much. But it's important to note that their CEO said only 1/3 of restaurants are performing at or above their standards, while 2/3 represent, quote, a meaningful opportunity for improvement. In other words, they're not doing so hot. Again, I think part of that is pricing. I haven't looked too far into the causes of it. But when Americans are making less money and that money is going towards more expensive rent, more expensive utilities, etc., you're going to have less money to spend on expensive salads. It's pretty basic math. And so although that was brief, that's basically all I feel is important to know about SweetGreen at this point. So before we hop into any of the numbers, could you please take a moment to like the video, subscribe to my channel if you enjoy different breakdowns like this, and leave a comment down below if there are any stocks that you would like analyzed. I always love having suggestions. Thank you so much, and let's get into the numbers. Taking a look at the company's income statement, we can see that there's been really great revenue growth over the last 5 years, averaging a 33% compound annual growth rate. Although I do want to point out that from 2024 to 2025, that growth rate represented here in the light blue really started to level off. So SweetGreen's expansion has slowed down considerably on the top line. Of course, in the EBITDA and free cash flow numbers, those are both negative growth because the numbers are entirely negative, but we can see that they are getting less negative, so the company is slowly working its way towards economic profitability. That, of course, is going to be reflected in the margins, where both margins are going to be negative for the operating and free cash flow margin. But again, we do see continued improvement over time with a relative flattening between 2024 and 2025. So the company is, over a 5-year time frame, getting much better. Over a 1 to 2 year time frame, it does seem to be stagnating a little bit. The company has a really solid balance sheet as well. SweetGreen's quick ratio is 1.95 and its current ratio is 1.97. With both of those numbers over 1, you can basically assume that the company is safe from any type of major liquidity issues. They are able to cover their liabilities with their assets quite easily. Interest coverage is also basically maxed out. They have very little long-term debt interest that they pay, and the company has a decent amount of cash on the balance sheet. So again, very safe balance sheet. Now, taking a look at shares outstanding, it's important to note that 2022 is when SweetGreen went public. So we see this huge jump in shares outstanding because that's when the company hit the public markets. But even since they went public in 2022, we have seen a steady increase in the number of shares outstanding for SweetGreen, which would suggest that the company is not necessarily the most shareholder friendly at this time. They are issuing more shares to the open market and diluting your percentage ownership over time. SweetGreen does not pay a dividend either, as it is such a new company, so we're going to skip over that. Which leads us to the company's price to sales. And before we go any further, I do want to say that price to sales is going to be one of the most important indicators that we look at, because due to the lack of profits that the company makes, its price to earnings ratio, its EV to EBITDA, price to free cash flow, those types of ratios are not going to show up with any sort of significant information because it's all going to be negative because the company has never made a profit. So price to sales is quite telling right now for the company, and it does currently trade at a 40% discount to its long-term average, suggesting that now might be a relatively decent time to take a look at SweetGreen. I do want to point out, though, there was a very significant period of time from like mid 2022 all the way to late 2023 where the company traded at a price to sales of under 1, hitting a low of 0.53, which is quite low for any growth company. And so even though the company now trades at a price to sales of 1.87, which is well below 3.1, there is plenty of downside growth if we look at how the market has valued this company in the past. Now, as I said, due to negative earnings, the price to earnings ratios, price to EBITDA ratios, and their negative free cash flow and price to free cash flow ratios are not going to be helpful at all. But price to book is interesting because, again, the book value has been positive for the company this whole time. And we do see SweetGreen trading at a 42% discount to its 5-year average price to book of nearly 4 with a current value of 2.28. Now, once again, just like I said, for price to sales, the company, even though it does trade at a steep discount to its long-term average, there is a very long stretch of time where the company is traded at even lower numbers of 1.44, hitting as low as 1.09 on its price to book value in March of 2023. So again, still plenty of downside possible based on previous market valuations that this company has received. Again, enterprise value to EBITDA and enterprise value to free cash flow are not useful indicators due to the company not making an economic profit. Dividend yield, of course, doesn't matter because they pay no dividend, but the drawdown chart is interesting. And of course, this is not actually a 10-year drawdown because the company has not been publicly traded for 10 years, but SweetGreen is in a huge drawdown of 81.62%. Now, the reason being they had an IPO less than 5 years ago, and IPO prices in 2021 and 2022, if you remember, were pretty ridiculous. There were companies getting huge valuations for no reason other than the fact that the market was just really frothy, and SweetGreen is a victim of that. Because you can see that in the very first few weeks of trading, this company drawed down over 50%. So it almost instantly just went straight down, and that's not necessarily SweetGreen's fault, and it does skew the current drawdown data because it IPO'd at such a high valuation. But just like we saw in other charts, the company did see its relative low in valuations around 2023, hitting a peak max drawdown of 87.75%. So again, still some decent downside room based on all of the indicators we're seeing for SweetGreen, especially if the company continues to fail to execute. And that leads nicely into analyst estimates for the company. Now, how do we read this chart? If you're not familiar with my channel, basically the light blue line represented right here represents analyst expectations for earnings 6 months ago. Then the medium blue shows the 3-month ago analyst expectations, and then the dark blue shows current analyst expectations. And what we're seeing is that the very top line here on this chart represents 0 or break even, which is of course what we want to see SweetGreen eventually surpass and then become a profitable company. And between 6 months, 3 months, and today, we see our lines getting further and further away, meaning analysts are expecting SweetGreen to not only lose more money, but take longer and longer to become a profitable company. And I think that is one of the main reasons why this company is drawing down so much on the open markets, is because analysts were expecting SweetGreen to be nearly break even by 2027 with an earnings per share estimate of -9 cents only 6 months ago. But 6 months later, they're now expecting it to lose 47 cents per share in 2027, which is even lower than what the company was expected to lose this year just 6 months ago. So quite a bearish turn for SweetGreen, and the analysts are really punishing the company for that. Of course, this leads to some very negative implied price to earnings ratios, but that doesn't really help us because, like I said, everything is negative. So we should check out our X factors. And again, 2 of our 3 X factors, the PEGI ratio and the FG ratio, are kind of useless because the company does not make a profit. So it's very difficult to judge the ratios of profitability against its growth and yield if, like I said, it makes no profit. But we can take a look at the 5-year earnings expectations. And the reason it's such a nice round number at 16% is because I saw really conflicting numbers everywhere I looked. Some places would show closer to 7% growth. Some places would be closer to 30% growth. So I really tried to average the consensus 5-year growth rate to something that felt like the middle of the road based on analyst expectations. And then that ended up being around 16%. And let's make no mistake here, 16% is excellent. It's a really, really solid growth rate. And that is one thing that makes SweetGreen a very interesting company today. You're not necessarily buying a profitable company, but you're buying a company that's in its major growth and expansion phase. So ideally, if everything goes right for the company, it'll continue opening stores, it'll continue to burn cash, but all of that cash burn will eventually pay off in huge earnings per share growth. So to recap, I give SweetGreen a safety score of 2 because the company does have a very strong balance sheet, but I do think it's quite clear just in my basic research of the company that its product is fairly expensive. They do try to cater to a slightly more affluent group of people, but it is consumer facing, and when consumers are struggling to make ends meet, expensive salads are one of the first things they're going to cut from the list. So while the company does have plenty of assets to weather a storm, the storm will be especially bad for the company whenever that storm does come. That's also a major factor in my quality score of 2, because SweetGreen does seem to be a very well-run company that hits its niche in a well-managed and well-executed way, but the customizable salad niche, again, it's for a slightly smaller target audience, affluent people that can afford to pay $15 for a salad. And that niche is not particularly large. It's not a McDonald's that everybody eats at, whether you're making $10,000 a year or $10 million a year. So there's an inherent lack of quality, I think, in its ability to expand in the long term. And I think that's showing up today in those flatlining numbers as well as continued analyst down revisions. So moving on to value, again, I give the company a 2, very middle of the road. Why? Because first off, it doesn't make a profit. I prefer to invest in companies that are making profits just in general. But SweetGreen is quite a young company, and the valuations that we can take a look at, such as price to earnings, price to book, taking a look at its growth rate, there is reason to believe that SweetGreen does have some value here if you believe that SweetGreen can return to its growth stage. And I think that's the big question mark is, can SweetGreen actually keep up the growth that it was showing in the last 3, 4, 5 years when the company was growing at double digits, 15, 20, 25% rates, at least on the top line. And then finally, moving on to X Factor, I give it a score of 1 because the analyst expectations, even on the low end of like 7 to 8%, that's really not bad for a restaurant company. But when I average everything out, it comes to around, let's say, 16%, and that is quite solid. So SweetGreen does have the potential to be a huge grower, and that is significant. Of course, the other 2 ratios are highly dependent on being a profitable company, so there's really not much to say other than it's not profitable. Those are kind of null and void ratios, but I'm also not going to give SweetGreen any points for them because they're null and void because, SweetGreen makes no money. So with all that, the company gets a 7 out of 15 as the final score. And I think the important takeaway for me, at least, is that SweetGreen does have potential as a company and as a long-term investment. I'm personally not quite sold at its current price in the $9-ish range. I would like to see it come down even further. I would love to see the bearishness just get to an extreme where this company is trading maybe at its 2023 lows in like the $7-ish range, I think is where it was, or even below that. Because I do think this is a company that could get sold off really heavily if there is a major consumer spending recession, which economic data points to a slowing consumer in general. So I think that is a serious consideration that we need to keep in the back of our minds. So with that, SweetGreen is definitely something I'll keep on a watch list. It's not a company that I would invest a large sum into, but it's a speculative play in my opinion. And of course, this is my opinion. It is not financial advice. So please do your own research as always. And with that, guys, thank you so very much if you made it to the end of this video. Please like it. Subscribe to my channel if you like stock breakdowns like this. I cover a wide range of stocks. And if you do have any stocks that you personally would like covered, feel free to leave a comment down below and I will take a look, maybe give my thoughts in the comments, or maybe make a whole video for you. I'm always looking to interact with you and see what you guys are thinking. So with that, have a wonderful day and I will see you guys in the next video. Bye.